Hello everyone. Next book you have to read in order to be a successful trader is Volume and Open Interest. Look, volume and open interest. First, in first book we learned about the volume. Now the second very important point, very important thing is open interest. If you are not using the open interest in your trading, you are not a good trader. Open interest is very important. And first important thing is volume. You have to use volume in your trading. Second important thing is open interest. Open interest is very powerful. Okay, if you are not using it in your strategy, you are actually way behind from the market. So if you want to be a powerful trader, be a equipped trader, you should have in your list volume but open interest as well. So you have to use both volume and open interest. So in order to understand the concept of open interest, download this book, Volume and Open Interest Classic Trading Strategies for 24-Hour Market by Kenneth H. Charlene. Download this book from your Google. You can easily Google that, and it's easily available on Google free. Okay, then read this book 2 to 3 times. I want you to understand this concept open interest. It's very powerful. I am again and again saying it's very powerful. If you know about open interest and its concept, then you will be a better trader. You have very high confidence in your trades, and you know where market can go, and you have a lot of confidence in your trading. Open interest will help you in determining the market direction in which side you have to play. So open interest is very important. Okay. Now let's start. Read this book 2 to 3 times. These are the go through these things. Now catalog of charts rationally. First of all, go to these points. Go to these points. Go through these points. Okay. Volume and open interest can identify how traders are reacting to changing conditions. Analyzing volume and open interest change results in a determination of which contingent the long or shorts are in the strong hand. The position of the strong hand is the direction of the major trend. Strong hands are deemed the smart money. Interpretation of volume and open interest changes are an attempt to identify the smart money and determine what this contingent of successful traders is thinking. So basically, open interest and volume, when we use them collectively, we are actually tracking the footprints of smart money, what smart money is doing, and then we trade in alignment with those smart money plans. Okay. Go to these all three. You have to read this book 2 to 3 times. Go to these things. We already discussed about the first book, Master the Market. We touched the volume section there. Volume spread analysis, a separate method. And furthermore about volume, this book will help you read this volume thing. Buy volume is equal to sell volume is equal to total volume. Simply, in terms of stock market, buy volume is equal to sell volume is equal to total volume. Then you go through the significance of volume. Volume is the measure of urgency. Okay, so through these things, you will understand easily what author is saying, and you will better know what he want to say. Now, in order to have a healthy uptrend, when price is going up, mostly the volume, they are using bar chart, but we use the candlestick charts. When market is going up and volume is increasing, and volume market is going down and volume is decreasing, this is a bullish volume. I told you in our previous lesson 1 in Master the Market that this is a bullish volume behavior. So if trend is very strong, trend is trustable, then the volume is slowly increase with increase of price, and when market go down, volume should decrease. So it means market is participating in the upside moves and market is not participating in the downside move. And when market goes up, again market volume is increasing. So market is actually participating in the up moves and not participating, not interested in down moves. So that is basically the concept here. So it is price versus volume relation. You have to read this book. You have to read these all things. I am going forward because I assume you will read all this thing. Read this thing very carefully. How these charts are showing. Okay, you have to read this book very carefully. This is a soybean chart, and the interrelation of volume. Look, market is going up and volume is increasing. So it's market is participating in upside move. When market is going down, volume is decreasing. So basically, author is trying to mention this thing again. This thing. Author is trying to mention this phenomena on these charts. Okay. Now read this thing. Now, for ideal healthy price downtrend, volume should be bearish volume. The bearish volume means price goes down, volume goes up. Price going up, volume goes down. Means smart money is actually interested in downside moves and not interested in upside moves. So in this way, price when come down, volume will increase, keep increasing. That means smart money, big players are actually interested in downside move, and when market goes up, they are not interested in upside move. Then market goes down, then they are interested in down moves. So that's why volume is participating in down moves and volume is not participating in up moves. So this is indication of healthy downtrend. Okay. Now, blow off volume. That's very important. Blow volume means sorry, okay, that's very important. Okay, it is not full. Blow volume is volume only high shoots voice like when it is back up and you see a very ultra high blow off volume, then you have to be alert that market can reverse. There is top, that top is very and market is going down. Again, there is a high volume. Then you have to alert that market will make a bottom and then start going up. So blow volume is basically the same. So read this thing. Kevich in order. Extreme volume is the warning that indicates at least a trend change. Okay, read about this Kevich. But the obvious read this thing. Bull case. In bull case, what volume? Low volume can be best understood in specific markets. For instance, in bull market, volume suddenly explodes. This volume surge can happen during the trading session, which course close up, down, unchanged. When the posting volume watching, read this whole thing, you will better understand what author is trying to say to you. Now this is blow volume. When market is going up, suddenly market have a very high candle within closing in the middle. I mean, sell a bearish candle or bullish candle with some small body, and there is ultra high, extremely high volume. This is the sign that this is a blow of volume, and market will reverse. Similarly, when market goes down, when there is a sell candle closing in the middle, small body of the candle, big spikes, and volume extremely high, that indicates that price will reverse and go up. Read this thing. In bear case, again, author will tell you about that. This is the blow volume, and basically actually indication that market can reverse from there. Okay. See, volume blow volume is very high, extremely high volume than previous 30 bars, extremely high volume than previous 20 to 30. Look, when we read the volume, we compare it with previous 20 to 30 volumes. So this volume is very high compared to previous 30 volume. So it is a blow of volume. It's an ultra high volume. You can say that it is ultra high volume, extremely high volume. Again, there is a very high volume. It's a blow of volume. It means smart money is active at this place and it's actually buying because market is going down. Aggressively, smart money is buying there. So market will slowly settle and go up in coming days. Now, high volume versus low volume. High volume versus low volume. Breakout volume occurs at the beginning of price move of often on the penetration of a trend line. When market tries to break out from a trend line or from a range, a breakout volume is needed. Normal high volume is needed. Okay, okay. And if low volume typically found after an extensive price move has occurred. So don't mix high volume with low volume. Low volume is very extremely high volume, and normal high volume is normal high volume. So average to normal high volume, don't mix it with the low volume or extremely high volume. Okay. When market goes for the breakout from a triangle or from any pattern, when market goes for a breakout, then market start to penetrate from the trend line. When the market start to penetrate from the trend line, market needs power for that to break that trend line. What from where it takes power. It takes power from the volume. So you will see slightly high volume on breakout stages, and when you will expect the blow of volume when market price move to a certain stage, an uptrend established, then after the near the top you will see the blow of volume, and that will reverse the trend. Okay. Normally when this blow of volume comes in, then market will print one more high or low after that to next session, at least one session forward before reversing. That is also point discussed here. So read this book carefully. I told you, read this book carefully. Tick volume is basically number of how many time price changes within candle in particular period is called tick volume. You can read that. Look, when price is going up and when price was on the breakout, look, volume is the confirmation for that. Volume is high, not a blow of volume, very high volume, but a normal high volume. So market, this volume is actually validating that this breakout is real. The market can go up. Okay. Point and figure charts, ignore that. Don't read that, ignore that. Convention, read that. Okay. Open interest, the very important topic, the open interest. Open interest is the summation of all unclosed purchased or sales at the end of trading session. Open interest basically are the contracts open currently in the market. Simple as that. Open interest is basically the summation of all contracts open in the market, submission of all trades open in the market. That's it, you can say that. Confusion concerning the open interest can be avoided. Open interest is basically long open interest, short open interest are equal, and total open interest are equal. It's very obvious. Then when you buy, someone sell, and how there are many buyers, then there are many same there are sellers in front of them. So when a contract or trade happened, a buyer and seller meets. So seller sells, buyer buys, and a contract happen. So seller and buyers are equal in the market. Now you will say that how market moves. Market moves when someone is aggressive. If buyers are aggressive, then sellers, then market go up. If sellers are aggressive, then buyer, then market go down. That's how market moves. But basically buyers and sellers are equal, and so is the open interest, because we in open interest we actually add all the unclosed deals in the market. So open interest is basically the all open contract in the market currently. Okay. So open contract, if we say long buy contract, similarly someone short against them, so short is equal than buy. So this is a total open interest. Okay. So future trading is a zero sum game. For every dollar in there is a dollar out. If you trade in future, you know better that future is a zero sum game. When you buy, someone is sell, and when you sell, someone is buy. Overall net is zero. Zero sum game. Okay. Now admittedly the exchange clearing house and member scoop a little off top, but of every open position in the future market there has to be a opposite position. Okay, like someone try open and buy a trade, then similarly a short trade is also open. That's why a contract happened. Okay, at the end of each trading session the long open interest by definition must be equal to short open interest. Okay, published open interest figures are similar to those for volume, in that what is reportedly by the clearinghouse to the public. Read this thing. An open interest is constructed at the bottom of the each daily high low. Read this thing. Okay, read this thing. Now the point is how open interest changes. This is the main point of the, this is the main agenda, the main point you have to check, that whether an open interest is increasing, whether open interest is decreasing, whether there is no change. These 3 points you have to determine to read the open interest, and you have to judge it with the market action candlesticks, and then you have an idea that what's going to happen. Okay. Now open interest from one trading session to next, these fluctuations fall into the 3 categories. Whether open interest increase mean more trades are opening in the market, more contracts are being opened in the market. Decrease mean more trading are being closed in the market, buyers are closing their buy, or sellers are closing their sell. Okay. And increase mean buyers are opening position or sellers are opening position. So in both cases, open interest will increase when there are more traders who are opening buy trades in the market, then open interest will increase. Or when there are more traders, they are opening sell trades in the market, then open interest increase. Now if buyers are closing their contracts or their trades, or sellers are closing contracts or their trades in the market, then open interest will decrease. And if they are doing nothing, or they are just one is buying, one is selling, and they are in equilibrium, then no change. Each of the 3 situations will determine what market will going to happen. For this illustration, it does not matter what price move up or down. What is necessary is that a significant price change occurred, while no specific definition of what constitute the significant will be given. It is safe to assume that the definition begins at more than 5 minimum ticks. Okay, the technical, read this out. You have to read this section very carefully. I am telling you, this open interest chapter, read this 5 times, 6 times, 7 times. This open interest chapter on this book, read this 5 times, 7 times, as much as you can understand it. It's very, 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 very important. I telling you, if you don't read other chapters, okay, fine, read this thing very carefully. Now there are cases. Case 1, open interest increase, like total open interest was 1,83,000, and a change of plus 3,000 means 3,000. If there was a total open interest of 183,000, and next day when we observe the open interest, then open interest, no, look, there is an example. Previous day the open interest of, for example, gold was 180,000. Let's say on gold the open trades were 180,000 contracts. Okay, and next day when we saw that open interest increased and the now positions are 183,000. Okay, so there is a change of 3,000 contracts. So it means that 3,000 buy trades opened or 3,000 sell trades open. These 2 possibilities are in front of us, whether 3,000 buy trades are open, whether 3,000 sell trades open. Basically both are the same thing. Open interest decreases to buy 2,000, then the net open interest from say 1,80,000 is now 1,78,000. 2,000 long contract close out, buy trade closed, sold out, and short covered means sell trades close out. Okay, and in third case no open interest change, always same. So these are the 3 cases you will see while reading the open interest. Read this all thing. Significance of open interest, very important. Unchanged open interest means the same number of participants are in the market. There may have been some changing of position. Old positions have been meeting margin calls. New positions may have been initiated, balancing the liquidated losing position. What is important, that fuel is available to the market. Okay. Significance of open interest: for every profit dollar in future trading, there must be a loss dollar. Okay, for every profit dollar there must be a loss dollar, because there is a zero sum game. Open interest is a reflection of this very important concept. Uh, if a future trader makes a correct judgment, where do the funds come from to pay his or winning trade? The funds come from the loser. This may be sound harsh, but it is the fact that a technician should be very interested in what the losers are doing. Read this thing, very important. I telling you, very important. Open interest provides the fuel to sustain a price trend. When market is going up and open interest is increasing, it's very important that price is trend is very strong. Trend is very strong. If market is going up and open interest is increasing, then it means trend is very strong. I am telling you, trend is very strong. You have to trade in the long side. You have to trade, don't have to sell. You only look for the buy opportunities. Analog of fuel is to the market is like the fuel to a fire. If the fuel is removed from the fire, fire will go off. If the fuel is removed from the price trend, trend will change. Fuel in future market is provided by losing position. When one open interest declines, fuel is being removed and the prevailing trend is running on borrowed time. For a healthy price trend to continue, open interest ideally should increase, at least not decline. This is an important concept, that remembering that the word fuel as a surrogate for open interest will place a trader ahead of 80% of all future traders. So you are when you use the open interest, you are 80% ahead of all traders. Open interest indicates the existence of difference of opinion. You can read these all things. Open interest determines if the loser are being placed. Read this all thing. I telling you, read this all thing. For ideal happy uptrend, read this all thing. Okay. A healthy price uptrend is expected to continue. Both bulls and bears are increasing their position. That is how the healthy trend will continue. And how how we can judge that buyers and sellers are opening position by open interest. Open interest is increasing. The longs, however, are in control. Longs are the smart money. So market will take which direction the smart money is actually moving towards, is actually trading towards that direction. Technician always attempt to monitor what smart money is doing. In an uptrend, there is obvious bulls. If the longs are increasing their position, losers are being replaced. Open interest will expanding. The price is technically healthy. When open interest increase along with the price, existing longs may be adding to their profitable positions and new longs may be joining the bandwagon. Additional short sellers may be existing shorts adding to their losing positions. It does not matter which is occurring, both represent a healthy price uptrend. Read this all thing. When price is going up and open interest is increasing, that's a healthy uptrend. Don't sell in that market. Never look for selling opportunities when market is going up and open interest is increasing. Never sell in this market. Always look for the buying opportunity. That is the basic concept. This is the example they are giving, that market is going up and this open interest line is picking up, and when market is going down, this open interest is dropping. Basically market is not weak, market is strong. That's why when market goes up, open interest is increasing. When market go down, open interest is decreasing, because that means healthy uptrend, healthy bull market. Open interest is very powerful than volume as well. Okay. Unhealthy bull market. In unhealthy bull market, when market is going up, open interest is decreasing. That means fuel is being removed from the market. No more trades are opened in the market, so price is going up without any power. So if market is going up, open interest is decreasing, never buy aggressively in this market. Look for the selling opportunities. There is a very high chance that top is very near and market will come down, or market will at least do correction. A caveat, read this thing. Healthy downtrend. In healthy downtrend, read this thing. In healthy downtrend, market will go down and open trust will increase. It means market, a market is going down, more buyers and sellers are being added, and more fuel has been adding into the market, and market is actually interested in downside. So open interest is increasing when market is going down. It says market is very bearish. Don't look for buy opportunities, only look for sell opportunities. Look, market is going down and open interest is increasing. That means that is a healthy bearish trend. Okay, sideway price action activity. When market is going down and open interest is decreasing, that means not a healthy bearish market. It means very shorts are being covered, and liquidating market means sellings are closed. Sellers are closing their sell trades. So when sellers are closing their sell trades, mean whenever a sell is been closed, market will act as in bullish power, as in bullish pressure. So market will actually going near to the bottom. Look, market is going down, open interest is decreasing. It is not an healthy downtrend. Market is expected to come up in the coming days. Price steady and open interest up. Read this thing. When open interest increases, new bulls are buying from the new bears who are selling. This is an aggressive posture of both sides. Price are not expected to remain stagnant. Once price break out with a close outside a trading range, simply liquidating the losers will carry to court a considerable return. Listen very carefully. Whenever you see a breakout, whether from a triangle, whether from a bullish flag, whether from any sort of breakout, consolidation, or whenever you see a breakout, and when breakout happened and you a bullish signal. Look, there is a breakout. In triangle there is a breakout. Price steady, open trust down. What does that mean? Read this very carefully. Read this thing. Okay, read this thing. I am telling you, this book is very important, and this open trust concept is very important. Wherever you see this open trust Look, price is going up, open trust is going up, and volume is going up. So that is a alignment. So it means that market is in a healthy uptrend. Okay. Short covering means when sellers close their sell trade, that means short covering. Simply is that when there is a sell trades in the market, and people are trying to close their sell trades, that basically result in a buying pressure in the market temporarily, and that we call it going down. Price is going volume is coming volume is increasing, and open trust in on an upside breakout is more crucial than open trust. But I tell you, not volume, open interest. This book is actually just saying that volume is actually very important, but I think open interest is more important than volume, while on the on judging the real breakdown or real breakout. Simple as that. Read these things, whatever he's saying. Read and read this chart, and just how he explain these charts in the read this all thing. The premise is that open trust changes can still be used to test for the direction of major trend during holidays. Sometime there is USD holiday or bank holiday or GBP bank holiday, but still open trust will work. You cannot rule out open trust. You should use open trust, and that will work. Okay, read this all thing. Euro dollar example he is giving here, and on euro dollar he is highlighting these all things, and then open interest behavior, and then he is explaining all this thing. You have to read this word by word. Okay, look what I want. I want you to read these all things, and read these multiple times, and you I want you to why total volume and open trust are used. Read these all things. Read these all things. Rollover judge. Read distribution of open trust, very important. Read this thing. Read this thing. Developing a discipline approach. Read this thing. Now you have this worksheet. Okay, this worksheet that they are giving an example how they use this worksheet. Look at example below. They have a case study, and they have a chart, and they transform it onto the this worksheet. They label all the open trust figures, all the volume figures, and they are then telling you that what does that mean. That's very important chapter. You have to read that. Look, they are explaining every day. Thursday they are explaining every day. Look, they are telling you that this is bullish, this is bearish because open trust increase, volume is also increase. This is bullish because open trust decrease, but volume is they are actually telling you all this. Okay, the price change is mentioned here, and volume open trust is mentioned here, volume is mentioned here, and they are then judging that whether it is bullish or bearish. So they are in last 5 days the market is more bullish than bearish, because one time its reading was bearish, otherwise it was bullish. So overall market is bullish. Sure. So okay, Friday, Monday, Tuesday, they are explaining everything. Wednesday, summary. So summary means what they concluded. The final step is to add up the bullish and bearish reading to arrive at weight of the evidence verdict about the direction of trend. At 7 bullish signals versus 2 bearish signal, major price trend is considered to be up. Okay. Read this all things very carefully. Specialized problems. Read these things. Read this thing very carefully. Read this thing very carefully. Price is going up and open trust is also increasing. It's a healthy bullish trend. Price is going down and open trust increasing. It's a bearish trend. Okay, both are the valid trend. Read this all thing. These are linkages and every basic trades and volatility trades. Just read them one time. That's it. I want you to read open interest and chapter very carefully. Read this thing. Now this is very important. Look, they are actually open trust conclusion. So read this thing. Read very carefully. Read all this thing. If you want to be a successful trader, you have to do some work, and this is what you have to do. Read all these things. Read this all thing one time. They must storable versus perishable commodities. Read these things one time only. Tax spreads etc. That is about options and treasury bonds. Ignore that. Ignore those things. Ignore those things. Open interest rate futures. Ignores those things. Ignore it. Commitment of traders, very important. Court report, read this thing. I will make separate lecture for this thing. Okay, but read this very carefully. Commitment of court report. This is very important. Okay, read this thing. How reports will be, who are the non-commercials, who are commercials, who are non-reportable positions. Read those things very carefully. Okay, read those things very carefully, very carefully. This is very important. Read them very carefully, very carefully. This court report chapter is very important, very important. Now, support and resistance, you can read that as well. What is support and resistance, and how author trying to say to you on that. That basically he tells that when there is a top market breakout, then that will act as a support in future. But that was a resistance. When that is breakout, then now this is a major support. That is the true support or resistance to read. And now true resistance, when there is an support and that is broken, then market is actually act that as a resistance for the next market to test. Okay, read this very carefully. Read those things very carefully. Asian and European Forex Exchange, use of voice, future volume, and open trust. Read that very carefully. These examples are very important. You read that and you will have an idea about what's going to happen. Look, they are actually explaining every day, Wednesday 23 November, and they are explaining what's happening there, and they are actually doing the volume analysis as well. Look, they are doing volume analysis on that example, and they are doing open trust analysis on there. So by reading that, you will actually have an experience of using the open trust. Okay, read those things carefully. Key reversal points, okay, at low or at high. Gold example, you should not skip that. Read this example 3 to 4 times at least. Open trust and volume analysis, read these things where 3 to 4 times, I'm telling you. Treasury bond example, ignore that. Assessing the validity of upside breakout, read these things, this is very important. Was it really a short covering? That is very important, read that. Read those all things. 24 hours trading, history of, just read that bus one time. Open trust and volume is the very important. Read all these things. Look, they comments on that thing, volume and open trust and what's happening. Read this all book, I mean. The data, CME Mercilline. Just read all this thing, simply is that. practical exercises. Read this thing. Look, when price is going up, volume is going when price is going down and volume is up, and open interest is also up, that represent the healthy price downtrend. This is very important. When price is going up, volume is down, and open interest is down, that is mean uptrend is doubtful. When price is open interest is down, price is going up, that means a short covering rally and a downside direction will be expected. When volume is down and the price is down, is a weak situation and upside direction should be expected. That's very important. Fifth stage, when price is up, volume open interest is up, is a very bullish signal. Okay, so read those all things is very important. But that's it. You have to read this book 3 to 4 times. Most important chapters are, let me tell you, the most important chapters are, let me tell you, most important chapters are open interest and court report. Those are the most important chapters, but you have to read all this book 2 to 3 times and understand it. If you understand this book, I am telling you, if you understand this book, only this book, you understand it very carefully, you will have a very powerful edge on the market. You will kill the market. So you have to read this book very carefully, and that is how you will actually have an idea of what open interest is and what volume is. For volume, you have already learned master the market book, and for open interest and for court report, you have to read this book. That is very important. It is available on internet free. You can download that and just read this 3 to 4 times and understand it, and you will have a very powerful reading on that. Okay, thank you.